Excel accounting practice problem, bill form. Get ready, because we're about to excel with Excel. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, we got two tabs down below, example tab, practice tab, example tab in essence being an answer key. Let's take a look at it now. Also note, in prior presentations, we put together this entire example sheet from a blank sheet, which is great practice. You can go through and put that together if you so choose. In our example tab, then we're going to be looking at the activity that might be put in place with a bill type of form in an accounting system, or in other words, if you use something like accounting software, the transactions are typically going to be tied to a particular form. The transactions that increase accounts payable within accounting software usually been done so with the data input for called a bill. When we think about a bill from this standpoint, we've got to differentiate a bill from an invoice, even though they're kind of the same thing, but from different sides of the table with regards to accounting software. So in other words, most accounting software, the bill means that a vendor is going to be billing us for goods and services that we have then purchased, cash ultimately going out at the end of the day to pay for the goods and services, as opposed to an invoice, which is we're going to be the people that do the goods and services and are billing or invoicing the clients, which we'll talk about later. A bill form might look something like this at the bottom with regards to a accounting software, and the bill form is set up so that the data input can be as easy as possible by someone doing the data input that doesn't really know how, or doesn't need to know how per se, to set up the bill with the items and so on, and what is going to be the impact on the financial statements. What we want to do is now look at the behind the scenes work, basically in an Excel formula, an Excel format, to see what's going to happen in the Excel system with regards to the creation of the financial statements. So we're going to have three kind of components. If we have a bill and we're paying accounts payable, we might be paying for a normal kind of expense, or we're going to pay in the future. We're basically incurred some normal expense like a utilities expense. We may have purchased something like equipment that we're going to pay in the future, and that would be a fixed asset. And then we'll take a look at inventory, which is possibly the most complex if we're going to be tracking inventory within the accounting system. So let's go back to our practice tab, and we'll enter those into our items here. So let's say the first one, let's say we're entering a bill, and let's say the date was 1/15, and we're paying the utility bill of some kind, like the electric company or something like that. So we're going to say that the expense then would be utilities expense. Now, when you enter this into a system, it looks like a check here on the way it would enter into like accounting system. You put the name, which would be like Edison or something like that, the date, then the amount, and then over here on the expense tab, typically if we're just going to be assigning an expense, we would put the account that's going to be impacted, which might populate automatically if it's like the second month of data input, because we'll follow what we did last time, which would be utilities in this case. If we do that with a debit and credit format to see what the impact will be, we're going to say that the expense is going to go up with a debit of utilities expense. And if you don't fully understand the debits and credits, then working problems like this will give you a better understanding of the debits and credits and how kind of they function. But it does take some time to really understand debits and credits. It's not exactly just knowing math. There's like rules to it, like a puzzle that's a little bit different than just math. So take some time to do that if you so choose. The other side then is going to be going to the accounts payable, which is a credit balance account. So there's the credit balance account, and then we'll have the amount, which I'm going to just say is $500 for the utilities. So I'm going to put the $500 on the debit side. The debit's going to go up. The utilities is an expense account, which have debit balances. And every time you do the same thing to it, you'll increase it. So we're debiting a debit, so it's going to go up. The accounts payable is going to be on the credit side, which we're representing with two columns here, which is the traditional way to do it. And I'm representing it with a negative number. Note that negative number then kind of means something different, even though we're going to be using the mathematical formula of it being negative to make our format easier to use in Excel. But it also means a credit, which is something different than being negative. So although we're going to be using the fact that it's a negative for Excel formulas to kind of work the Excel formulas, you also kind of need to think about it in terms of debits and credits. That takes a little bit of a time to do. The most transparent way to post something like this to see what happens is actually just simply to post it into a trial balance like this that looks like basically an adjusting entry type of trial balance, giving us an adjusting column in the middle, because that allows us to see the beginning balances, the change, and then the ending balance. So let's do that now. Let's post this utilities account to the utilities account down below, which is right here. I'm going to post it to the blue area. We're always going to post it to the blue. In the blue area, I'm never going to put a negative number. It's always going to be equal or plus. So I'm going to say this equals, I'm going to pull over that 500, and it took this 1,900, it went up by 500 to the 2,400. It's a debit balance. We debited it. Anytime you do the same thing to it, it increases. Also note what happened is that we're out of balance here in our entries, and the ending balance is out of balance because we have more debits than credits. And you can also see the impact on net income. It was at income because that the negative represents a credit of 24,710. We then decreased it by 500 with an expense to 24,210. Then if we go up top, then on the accounts payable side of things, we're going to say the accounts payable is going to be equal to, that's accounts receivable. Accounts payable is down here, credit side, equal to the 500. Now it also went up in the credit direction. And here's what I mean about we're using the minus sign mathematically because it went 1,600 up by 500, or you could say down in the negative direction mathematically to 2,500. So mathematically you could say, well, it went down on the timeline to negative 2,100. But from a debit and credit standpoint, because we're using the negatives to be credits, the credit went up in the credit direction by 2,100. So that's a little bit of a distinction. You got to kind of, it'll get clearer and clearer when you start using debits and credits. Now we'd also want to post it to, so that will put us back in balance, by the way. Now the accounts payable went up. We're back in balance down here. And then there's no effect from that second part to the net income because that's not part of the income statement. Okay, so now we're also going to post it to the general ledger. The general ledger, sometimes like later on, we'll actually post it only to the general ledger and then use the general ledger to make the ending balances. But that's another level of automation. And once you do that, then it becomes a little bit less transparent for us to see. This transparency right here to see what the journal entries impact on the accounts are, quite nice. So let's do this. We're going to post this utilities all the way to the general ledger. Now this is going to be all the way at the end. It's the last account. So I'm going to have to scroll all the way over, and I still want to use formulas. So I'm going to go all the way to utilities. Here's the assets, and then here's the liabilities in yellow, and then the dark blue for equity, and then here's the expenses, and all the way at the end, and down here, we're going to have our utilities. I'm going to put the date here, which I think I said it was 115. I hope I got that right, possibly. And then I'm in AV, I'm in cell AV17. I'm going to do the same thing, equals. I'm never going to put a negative or anything in here. I'm going to say equals. I'm going to hold down the left arrow. I'm just going to hold it down till I hit the wall. I'm going to hold it down till I hit the wall. There's the wall. And then I'm going to go up. You can see the cells changing up top as we go in the formula bar. I'm going to find that $500, which is equals C2. I'm going to enter on C2. There it is. Now, if you want to just type it in there, if you're practicing, you could say equals C2 if you would like to do it that way as well. And what does that do? It took the 1,900 previous utilities amount, increased it by 500 to 2,400 because we have a running balance formula here. Once again, a debit balance account going up in the debit direction takes it up to 2,400. That 2,400 is also what should be on the trial balance. So if I go over to the trial balance, all the way over here, we've got the 2,400 right there. Looks good. Also note that we're out of balance on the trial balance by 500 now, given the fact that that we didn't record the other side to the trial balance. The other side now going to accounts payable. Accounts payable, I'm going to find that not on the trial balance, on the general ledger. The trial balance is in balance. The general ledger, the GL, is not. So let's find the accounts payable. It's going to be down here. It's the first liability account. So I'm looking for the first yellow account. So scrolling over, here's the accounts payable. I'm going to put it in here in cell W17, 115. We're in cell X17. I'm not going to put a negative, but just an equals. I'm going to hit the left arrow till I hit the wall again. Left until I hit the wall. Up until we get to our accounts payable. There it is, the 500, and enter. So there we have it. Now this one went up from 1,600. you can think about it from a plus and minus standpoint. It went down further on the timeline, the number line, to a negative 2,100. But we think about that as going up in the credit direction to 2,100. That 2,100 should be what's on the trial balance as well, because this should be supporting the trial balance. So there's the 2,100 on the trial balance. It also puts our general ledger back in balance up top. So the next thing we want to do is say, okay, this accounts payable is sorted now by the trial balance. It's also sorted by the fact by date here. But I also need to know who we owe the money to. Who do we owe the money to? So I need another ledger, which we call a subsidiary ledger. And that's going to be a ledger that will add up to the same amount, but is sorted by vendor. So I'm going to post the same accounts payable to the accounts payable subsidiary ledger, which we put way on the right, past the general ledger. So way over here, past the GL. There's the accounts receivable subsidiary ledger. Here's the accounts payable subsidiary. So we got our vendors here. This vendor had 700. Let's say it's called vendor 4, which might be like the utility company. I won't change the name of the vendor, but let's just say it's like the utility company is vendor 4, and so I'm going to say 115, and I'm going to put the same transaction here. I'm going to do it the same way. I'm going to say equals. I'm going to hold the left arrow till I go all the way to the wall, and then scrolling back up. And I want that accounts payable again, which is going to be in cell D3. So D3, you could just put equals D3 if you want. And that brings us back up to that 500 here. So 500 for that particular vendor. If I added up all the vendors, then it's going to take the ending balance of all vendors. That should add up to 2,100, which should match what's on the trial balance. And that would be indicated by the 0 here that it does. Let's double check. If I go back to the right, we've got the 2,100 here once again. Also note that this trial balance to 2,100 should automatically adjust our financial statements all the way to the right. The financial statements, there's the accounts payable has been adjusted. We're still in balance here because it adjusted it automatically. And our utilities got adjusted automatically here as well. And so everything looks like it populated on the balance sheet. Now note, in accounting system, most likely what would happen is you would post this and then you jump to your balance sheet and double check your balance sheet and then drill down on the balance sheet to see what's happening on the GL account, here. And then you would drill down by making another report that would be a subsidiary ledger report breaking this out by vendor. And you probably wouldn't be looking at the trial balance that much unless you like to look at the trial balance instead of pulling up the financial statements. So let's do that again. Now this time I'm going to say this one's on 120. I'll do this a little bit faster. And we're going to say same thing, but now we got this bill. We're going to pay something for a bill because we're going to pay it in the future, but we're going to pay it to say like an Office Depot or something for equipment that we purchased, a larger purchase item. Now over here, it always says expenses as if it's always an expense, but you could have a bill for an asset if something like equipment. So I might say, okay, I'm purchasing something that's not an expense. It's going to be furniture and equipment that I'm purchasing because it's a larger dollar amount. Let's say it's $5,000, and therefore I shouldn't be expensing it, but I should be putting it on the books as an asset. We may still run that through the accounts payable here. So it's going through the accounts payable. Here's our debit and credit again. Also note that you might indent this. Some people really like to indent this. Home tab, alignment, indent the credit. That I don't do that all the time because it kind of messes me up if I have to fix things and I got this indentation there. We're already kind of double indicating that it's a credit by having debit and credit column, and the credits are negative, and we're going to indent it here. It's kind of an overkill, but it depends on your taste and who you're working with and whatnot and what they like to do. So same kind of thing here. We're going to still be increasing the accounts payable, paying it off in the future, but this time we bought an asset. So we're going to put it up top on the asset. So if I was to record that here, I'm going to say, let's record this. I'm going to post it right here. We had 1,600, I should say. Now we're going to increase that by 5,000 to 21,000. And then the accounts payable is going to go up. Now there's something in it already. That's the downside to having a system like this, where you're trying to do this really transparent format. because if I have a lot of transactions and multiple transactions to the same account, I'm going to have to add them in one cell instead of breaking them out in the general ledger. That's why we break them out in the general ledger. But for just a few accounts, this works quite well, which is why we use it when we have the adjusting entries. So if something's in it, I'm going to double click on it. I'm going to go to the end of it, say plus. It's always plus or equals, and then take that 5,000 and enter. That should put us back in balance down below. There's no impact from this transaction on the income statement because now we didn't expense it. We will be expensing it later. It's not that we didn't expense it because we didn't pay cash, by the way. It's because even if we paid cash for it, we put it on the books as an asset. Still no impact on the income statement. We didn't expense it because it's something that's going to impact multiple periods in the future. We will expense it in the form of cost of goods sold, allocating the cost over the useful life. We won't get into the detail on how to do that now, but that's the idea. Just to point out, we do need a subsidiary ledger, but we're not going to report it to the subsidiary ledger because oftentimes we might depend on like tax software or something outside the accounting system to support that oftentimes. We'll talk about that later. But in any case, so now we're going to record it again to the general ledger. I'm going to record this account to the GL. So let's go on over to the GL and say we're looking for the fixed asset. Right there, it's in S17. I'm going to say 115. I'm in T17, and we're going to say this equals. I'm going to go to the left arrow till I hit the wall again, left until I hit the wall, up, and there's the 5,000, and enter. You could simply type in, if you so choose, the C5, and notice it increased debit balance, went up in the debit direction to 21,000. So the like things, a debit will increase a debit. That 21,000 should also now be on the trial balance. It was before. We're out of balance on the GL by 5,000 until we record the other side. The other side being to accounts payable, of course. That's the first liability account. So let's find the accounts payable. Here is the accounts payable. So the next transaction I said was on 120, I think it was. And I'm just going to say equals in X8 equals. I'm going to hit the left arrow till I hit the wall again. Scrolling back up, and we'll pick up that 5,000 negative. So you can see what's happening here. We got the 1,006. It went up in the credit direction. You can say it went down on the number line from a mathematical formula, but it went up from debits and credits to 21. Then it went up by 5,000 to 7,100. That 7,100 should be what's on the trial balance. It is. That looks good. However, we also need to record this on the subsidiary ledger by who we owe the money to. The subsidiary ledger is way over past the GL. So I'm going to go way over past the GL. And so here it is. And I'm just going to pretend that it was vendor 1 this time. So I'm going to say 120, vendor 1. Let's say it was Office Depot or whatever. And so now we're going to break this out by who we owe it to. Vendor 1, Office Depot. I'm in BH5 equals. I'm going to go all the way to the left till I hit the wall again, way over here with the arrow, and find that 5,000. Enter. Now note also, by the way, you could just type in negative 5,000. You might do that. But the less connections you have, connecting them with formulas, the more likely if something goes wrong, you won't be able to find out what went wrong. And you'll have to kind of do the whole thing over again. In any case, it's back in balance indicated by the 0. If I double click up top, we see that we're adding up these bottom line accounts, and those 4 vendors add up to the same amount, 7,100. That should be on the trial balance now. So there it is on the trial balance. There it is. Now the last one, the most complicated oftentimes, is inventory that we might purchase on account. And this would be common if we purchase inventory a lot. So now we're going to not pay for an expense. It's not furniture and fixture we purchased, but inventory. And then we're going to pay out later, so it's accounts payable, same concept. And that now let's just say we bought 1,000, which let's say we bought 20 units times $50 a unit, I think is how I'm going to say that. And so that means that we're going to pay from a dollar amount $1,000. We'll post this the same way. So I'm going to go over here. I'm going to be in inventory on H7 equals the 1,000. The other side to accounts payable. So we're out of balance now, by the way. So I'm going to double click on the accounts payable because something's in it. Go to the end of it, say plus, and point to that 1,000. Increase in the accounts payable to 8,100. back in balance down below. No impact on the income statement because once again, we didn't, on an accrual basis, we didn't earn anything yet. We will once we sell the inventory, therefore, and at that time, expense in the format of cost of goods sold. Now we'll post this to the general ledger. The inventory asset, let's do that first. So that's going to be like the fourth account over. Fourth account inventory asset. We said on this, I said 125, I think I said. And so I'm going to say this equals left to the wall. We're going to say 1,000. So it went up in the debit direction, 4,375, up by 1,000, 5,375. And then we're out of balance on the GL. Then accounts payable we will post. Accounts payable, this is our highlighted account. Accounts payable's in the spotlight. This is its moment of fame. We're in X19. This equals all the way to the left. Hit the wall. We're going to pick up that 1,000. And you could just type in equals D9. Some people might try to memorize the cell. It might be easier to do it that way. I use the arrows because my memory is not that long. I can't memorize 5 seconds. So there we go. We're back in balance up top here. Now let's post it to the accounts payable subsidiary ledger because we need to know who we pay, which will be the vendor that we owe when we buy inventory from. All the way to the right, past the GL, we've got our accounts payable subsidiary ledger. Let's say we purchased it from vendor 3 here. On 125, that would be whoever we purchase our inventory from, happens to be vendor 3, equals left all the way to the wall, down to the accounts payable, 1,000 again. So you could type in D equals D9 if you so choose. 3,000 goes up by 1,000 to 1,003. If I add up all the vendors, we are now adding up all the vendors and getting to that 8,100. It looks like it matches what's on the trial balance by that green 0. Let's double check. Going back to our trial balance, we've got the 8,100. Now, lastly, we're going to record that same amount to the inventory subledger because we now also need to be supporting the fact that we need to adjust this inventory number here. So let's do that. So I'm going to go all the way to the right, where we have our inventory. You can see it's out of balance now. And we purchased this first item of inventory, and we're going to use an average method. Remember, you can use like a FIFO, a LIFO average. I won't get into that in detail because we're really kind of focusing on accounts payable, but just note, you're going to have to update this. The subledger will update if you're using accounting software that tracks inventory. And then we'd have to put, I'm going to put 20 units that we purchased, and they cost 50 each. So we purchased 20 times 50. There's that 1,000. Our ending inventory then is going to equal same thing. I'm going to say the 20 times the 50. And so I'm going to multiply that out, 20 times 50. And then I need to get basically my average inventory. So what I'm going to do is underline this and say if I sum this up, I get to 70. And what I'm going to do here is I'm going to sum up the two items above it equals the sum of the 2 items above it. That gets us to the 3,500. So that means the unit cost is going to be equal to the 3,500 divided by 70, or $50. Now you might think about doing that a couple different ways given the fact that we use the same cost. But notice if this cost changed, like if it increased because of inflation, it was like 55, then they would have 2 different costs up here. And if we're trying to average them, then I'm trying to take like the weighted average. So that's what we're attempting to do here. If it's 50, then of course the weighted average will be still 50 at that point in time. So I'll underline basically these two. That 3,500 is flowing down to the end. So that means that my total for my 2 types of inventory still adds up to 5,375, which looks like it matched what's on the trial balance. Let's check it again, 5,375 going back to the trial balance. If I go all the way back, there's the 5,375. Note that on a bill in accounting software, to do that, you'd basically have to set up items to do that. And when you do the data input, then it's kind of like when you check something out at a check register or something like that at the grocery store. You know what the sales price is, but the software then just does kind of what we just did right there behind the scenes. But in order to set that up, in order to understand that, in order to understand the impact in the financial statements, you got to have some idea of what we just did there and understand what the inventory method is. Is it FIFO, LIFO, average, and what the cost is versus the sales price. So we're not concentrating on that now. We're just focusing in on the bill. But those are the major three kind of things that you could typically use a bill for. You pay for something, you're usually paying for an expense, or you're paying possibly for fixed assets. That happens less often. If you're in the type of company where you buy and sell inventory, you'll be purchasing inventory quite often. And then if we go all the way to the financials to the right, note they have populated automatically, so the accounts payable has gone up properly. It should have 8,100. We're still in balance here. The inventory has been increased, and we see that the utilities accounts increased, and our equity still ties out. So everything ties out here on the balance sheet. You can see how everything kind of ties together. If you put this into an accounting system with you would just have data input the bill, then when you check it, you'd probably be checking the balance sheet, checking things like the accounts payable, the inventory, possibly drilling down on it. When you drill down on it, say drilling down to the inventory, you would then most likely go to a transaction detail report, which would basically be the general ledger. It might be called a transaction detail or whatever, but it's breaking out the detail by date. And then you might say, well, I would also like to know what kind of inventory items, and look at your inventory items. Then you would be looking at subledgers, making another report backing up or supplementing, coming up to the same total as those accounts, which would be the accounts payable subledger in this case, and or the inventory subledger, which might be called different things in accounting software, but in essence, they're subordinate ledgers in that they're just going to order the data in some other order other than by date, but add up to the same amount on the primary ledger, that being the general ledger.